battling the relentlessly negative doom and gloom news media. It's the Nick Stenger Show, coming to you live from the Stenger Family Office headquarters. It's your host, Nick Stenger.
All right, ladies and gentlemen, welcome back to the Nick Stenger Show. My name is Nick Stenger. We are Stenger Family Office. For the past 43 long years, it's been our mission to deliver both clarity and confidence to help secure your financial future. We are back. We're bigger than ever before. We got producer Owen back in the saddle. Welcome back, buddy. Episode 163, the Fed finally cuts. Thank you for joining us for another installment of the clarity, the confidence, the good news, the reasons why you should stay on your plan. If you need any more reasons to stay on your plan, then today, which it is Thursday, September 19th, the S&P has just crossed over a brand new all-time high, 5718. You are so happy you stayed on your plan. You did not panic. You did not do what the one client did a few weeks ago and sell everything. Remember, I told you, don't sell everything. Don't panic. Stay on your plan. None of us know what's going to happen. We don't know what the future holds. We do know that the future does hold good things for equities. And I'm talking the long term of the stock market, the favorability, the probability, all of the odds are on the side of equities going up. We just don't know when that exactly is going to be. So you have to stay on your plan. You got to stay grounded in the reality of data. Now, has the S&P run up a little bit too much? Are we due for a correction? I don't know. I would guess at some point, we're in an election year. We do have these seasonal pullbacks, usually in September, October. We know the election's uncertain. We know that there's going to be bad times ahead. We know there's bad things coming. So is there a correction coming? Sure. Of course, there's always going to be something at some point. But you trying to time this out, trying to get in and trying to get out, telling me, oh, Nick, I think now's a good time for us to go to cash, but don't worry, I'll get back in when I think the conditions are right, and we'll get back invested. So that never works. Don't try and do that. And Peter Lynch, the famous mutual fund manager from Fidelity, ran one of the most famous and most successful mutual funds of all time, said more money has been lost preparing for a correction than in the actual correction itself. And isn't that true? That one client that I mentioned in the Sell Everything episode a few weeks ago is now down $75,000. I updated the math today with the market up at record all-time highs. And if he would have just stayed on his plan, he would have been fine. But instead, he's lost $75,000 in opportunity costs by panicking out of the market when he did. Now, in a week's time, he was actually right, and I was wrong. It looked like a good idea to get out because the market did go down about 4 or 5%. But the market came right back and is now higher than the price at which he sold out. And that's what always happens to people. So he's no longer a client. So what I would guess he's doing is he's saying, oh, this is not real. This is a dead cat bounce. This market going up today, that can't be sustainable. And we're going to have another pullback. And at the next pullback, then I'll get in. And then when that next pullback happens, if the next correction comes this year or next year, whenever it is, he will say, no, that's not quite time. There's going to have to be some further downside. This isn't the right opportunity. I'll wait for things to go lower, and then things don't usually go lower. And then the market goes right back up. It makes a new all-time high. So forget 5,700. Maybe the next all-time high will be 6,000, or maybe the next support level on the S&P will be 6,000 or 6,100 or 6,200 or something like that. And then at that point, you can say, well, now it's definitely too high. I can't get in now. And years will go by, and he'll stay in cash. And I'm telling you this because we've seen it happen to people. Thankfully, not that often. It's usually about once every 5 or 6 or 7 years or something like that. But for the rest of you, for 99.9% of you who stayed on your plan and stayed on the course that we charted out for you, you're doing fine, and you're happy that you just stuck to your financial plan. So that's where we're at. Now, the Fed did cut yesterday. I watched the entire Fed meeting. I listened to the speech, watched the Q&A session, and Powell is becoming a little bit more dovish here. That's why the market's up today. Now, a lot of this got baked in. We didn't know if we were going to get a 25 basis point cut or 50. Actually, most economists got it wrong and said we were going to get 25 basis point cut. We actually got 50, a little bit better than expected. A lot of people are now asking the question, well, wait a second, hang on. maybe Powell has seen something in the economy that he doesn't quite like, and that's why he's cutting more than expected. A 50 basis point cut is a lot, but I just want to put into context the fact that it's really not that big when you compare it to the levels of rates we've been at for the past year now. We've been at 5.25% to 5.5%. That's pretty high, the fastest hiking cycle of all time. And so cutting 50 basis points really doesn't move the needle a whole lot. And this is what you have to understand, especially when you get into the bond market, when you get into mortgage rates, when you get into all these different things that the Fed influences. You need to understand the Fed only influences the front end of the curve. It's the overnight lending rate. The market prices in all this stuff on its own. And so the 10-year treasury, the 5-year treasury, the 20-year, the 30-year mortgage rates, a 30-year fixed, a 15-year fixed, a variable rate, all these rates are based on supply and demand forces and how banks perceive risk. And how investors perceive risk, quite frankly. So the 10-year treasury is already down to like 3.6, 3.7. I didn't check it before the show today, but yesterday was about 3.6, 3.7%. It's lower than the 30-day treasury. Why is that? Well, the market's expecting that rates are going to be lower in the future. So a lot of this was kind of baked in. It was already expected that we're going to be lower. And it's certainly the case that markets think we're going to be lower 3 years from now, 5 years from now, and certainly 10 years from now. That's why nobody, including the federal government, is going to give you more than about 3.6, 3.7% for the next 10 years, because we do think Powell is going to be about that level. Roughly, if you look at the market today, we're expecting Powell is going to be right around 3.9% a year from today, and 3 years from today, around 3.5%. I would actually venture to guess that those rates will be even lower in 3 years if we actually get inflation under control. Now, the narrative is also going to be that Powell sees some weakness here, and that's because of the labor market. I don't think that's completely unfounded. And here I am, saying we're battling the doom and gloom on the weekly show. Well, some of the doom and gloom can't always be battled. Sometimes there is some doom and gloom out there. And part of it is the labor market. The labor market is definitely coming back to reality. And I'm not at the point where I think the labor market's weak. I don't think that's correct at all. But we are getting some mean reversion. Remember, we had COVID. We had this slow melt up where all these jobs were not being filled. We had record low unemployment under President Trump. And we had that COVID spike. And then things normalized, and it was hard to find workers. It was hard to get people to come back. And then you had the remote work trend where people are working remote 5 days a week. Well, that's starting to change now too. Amazon is saying they're going to be 5 days a week fully in the office. Tesla's saying it. Meta is saying it. Not 5 days, but they're starting to get back to that. All the large banks, all the large insurance companies, all the major employers are going back to the 5 days. So what's happening now is labor is normalizing. And if you look at unfilled jobs, that's the number of employers that are looking for workers that just can't find people to do these jobs. We are now seeing that number is coming back to reality. It's a pretty major drop. And again, we're not quite back to the 2019 levels that we had, October of 2019. We're certainly not back to the February 2020 pre-COVID levels. We were about 7 million unfilled jobs. Today, we're about 7.7 million. So the labor market is still pretty tight. However, it's loosening ever so slightly. And I do think there's some truth to Powell watching the labor market, because remember, one of the Fed's favorite metrics is this JOLTS report, job openings, labor turnover summary, and looking to say, okay, labor is weakening a bit. If you have significant labor weakness, what happens? Well, people lose their job or they can't get a different job. Well, probably employers don't have to pay as much, so real income goes down. That's been a real problem during the Biden administration that they don't want to talk about. Real income, real earnings are down. That's just a fact, and you can't get around that. And so under President Trump, we did have, don't take this as a political statement, I'm not telling you this from a political lens, just from a pure data standpoint, under President Trump, we had higher real wages. That means after inflation, people were making more money than ever before. Well, the past 4 years here, past 3.5 years under President Biden, we've actually had a decline in real take-home pay. Why? Because of inflation. And so there is some weakness going on. If people aren't making as much money next year as they're making this year, well, what do? They stop buying houses, they stop buying furniture, they stop buying clothes, they spend less, they do less vacations, and that's all bad for the broad economy. However, the saving grace, and I'm not saying this is good, I actually think it's a bad thing. The saving grace of the economy has been who? It's been the top 1%ers. It's been the top 10%ers. And so far, that's been enough to keep us afloat. And I'm not just talking billionaires. I'm not just talking people with net worths of 50 plus million even. I'm talking a lot of our clients. A lot of our clients are actually in really good shape. They don't have debt. They don't have a mortgage. If they do have a mortgage, it's fixed at 2.5% or 3%. I'm describing many of you watching the show today. You may even have cash in the bank. I had one of my clients tell me today they're sitting on $300,000-$400,000 in cash and they don't know what to do with it. And so this is not just an isolated thing. We have hundreds of clients we work with, and this is a common theme across the board. And so people who have are having more, and people who don't have less. This is the Matthew principle. It's baked in. And so this is why I keep saying, be careful with what you do with your personal balance sheet here. Be careful with spending. Build up a cash reserve. Be careful, because when the bad times do eventually come, it's going to be those strong hands, those strong households that buy up all the assets on the cheap. And that's what happens every single correction. We don't have to like this. And in fact, it's probably not a good thing. It's a bad thing that there's so much concentration. There's always going to be concentration. That's a fact of life. But it's gotten more and more concentrated as the tide has gone out, as rates have come up, as people have started to see, wait a second, things aren't quite as good on the surface as they may seem. There may be some cracks. That's when the big look even better. That's why large caps have outperformed. That's why the top 1% of families that have paid down debt, that have cash for a rainy day, that have securities, are doing okay still. Is that going to be enough to support the economy going forward forever? No, you have to have enough of the economy doing well. You're never going to have 100%, but you have to have enough of the economy doing well to have a thriving economy. And if you don't, what you end up with is China, or you end up with a lot of these Marxist places where there are a handful of people, an elite group of wealthy rulers who are doing just fine. They eat steak every night. They fly around in private jets. They eat caviar. They have, the V8 engines. And then meanwhile, they're preaching to you about how you can't have a toaster. You can't have a cow because it's going to fart too much. You can't travel. You have to have a green social score. You have to have a climate change score and all this nonsense. And then they go on their private jet to do their next concert, not naming any names. There's plenty of them out there that we could name. But the reality is if you get to a world like that, where there's so much concentrated wealth in such a few group of people, that creates civil unrest, that creates problems. So the beauty of capitalism, and what capitalism is supposed to solve, is in fact wealth inequality. There's always going to be inequalities. There's always going to be dispersions between the haves and the have-nots. But capitalism spreads out that ability for people to make money and to have a life. In socialism, in Marxism, and in communism, where they promise people to have equal, it ends up in equal poverty and equal disparity, or equal just absolute disaster. Okay, nobody has any money. Everyone's just equally poor. In capitalism, at least you have a chance to raise the living standard. So capitalism, I would argue, not perfect, not always the best for when you have crony capitalism. That's a bad thing. But raw, true capitalism is the only thing that's lifted people out of poverty. And you look across the globe, the only reason China is living on more than $2 a day is because we basically exported some form of capitalism to China. Without it, they would have collapsed years ago. And the same thing goes for the Soviet Union that did collapse. The same thing goes for Venezuela that did collapse. And so if you can show me one place on earth that has not been ruined by communism, I'd love to see it. Feel free to send it to me. Send me an email. Say, Nick, here's the example. You're not going to be able to find it. I can already tell you. I've looked. There's no such thing as a non-capitalist place, a communist place that has actually been able to survive. You need to have a thriving distribution of the wealth that's only enabled by capitalism. So that's enough on that. Is policy in the cracks emerge? Yes. And is it going to bring down the economy right this second? No. So could we have a correction? Yes. Are we going to go into an all-out recession? No, I don't think so. I think we're still a little ways from that. And the answer for now, at least, is going to be that the top 1% and the top 10%, maybe even the top 25%, is doing still okay enough to support the rest. And that is not fantastic, but that's just the reality of where we're at. So what do you do with your investments in light of all this information? What do you do with your portfolio? Well, I still think you be careful on the bond side. I don't think it's as easy. I don't think the bond duration trade, meaning you go out and buy 10-year bonds or you buy 20-year bonds, long-term duration, okay, thinking interest rates are going to come down. I don't think that's going to solve all your problems. And if it's that obvious, if it's that easy, it's usually not that good of a trade. And so sometimes what happens, because that 10-year has already priced in rate cuts, because the 20-year is already priced in rate cuts, it makes it very, very challenging to get a lot of excess return long term from the long end of the treasury yield curve. And so I still think you got to be short term. I think you need to go back to Financial Planning 101, goals-based financial planning, which says you got to have enough money for a few years of living expenses in retirement, set aside high quality, short-term, high quality, low duration stuff that's not going to bounce around when markets go down. Okay, that's just common sense. And so if you take that safe money in the portfolio and you want to go out and risk it on 20-year bonds, be my guest. We're not going to do that for our clients. I can tell you that right now. That's absolutely bonkers. That's not good financial planning. That's not disciplined rebalancing on a goals-based process. That's just chasing return, or you could even call it, chasing the trends and whatever people on CNBC are talking about. You got to be on that goals-based plan. I do not want to risk your safe money. I want to go out and I want to buy equities with the part of the portfolio that's supposed to grow and beat inflation, because at the end of the day, when it's all said and done, nothing has beaten inflation like equities. So you got to get that distribution right. What's the right mix between equities and then treasuries? And then be careful what you buy in there. You got to be careful that you're not buying these too many of these so-called defensive stocks, safe stocks that pay these big 6-7% dividends, because a lot of the stocks that pay the 6 and 7% dividends are only paying them because their stock got cut in half. They used to pay a 3% dividend. Now they pay a 7% dividend because their stock got cut in half. Just basic math. Okay, that's not a good company. That's not a company you want in your portfolio. Let's not name too many names. Some of them are on the shelf here behind me. One of them glaringly obvious, Walgreens, the darling of Wall Street. And I'm not giving you stock advice here. I'm not giving you investment recommendations. So don't do anything with what I'm about to say. But Walgreens is now down over the past 5 years, 85% price return. So who cares that it pays a 10% dividend? You lost 85% in 5 years. Not such a great return. That's what you have to be careful of. So go back to the goals-based plan. What do you do in times like this? What do you do when things don't really make sense? On one hand, the market's doing really well and it's up. On another hand, you may be worried about the 5 or 10 things that are going to potentially cause calamity in the next couple months. And you're thinking, Nick, why are these things happening at the same time? Well, the reality is markets discount the future. And I keep telling you that. So go back to your original plan, get it right. Something where you don't have to change it all the time. If you constantly have to change your plan, it wasn't really a good plan in the first place. I think that's fairly obvious. So go back to the drawing board, call a good fiduciary financial advisor, call us even if you need somebody to put a plan together for you that's going to stand the test of time, and then rebalance it once in a while. That's all you should be doing. Take some profits off the stuff that's doing well, reinvest that profit in stuff that's not doing as well. And over time, you'll be fine. And whatever happens in the next 2 months, whether the election throws us off or it's some unforeseen geopolitical event or a black swan event or something that comes up the next couple of months, as long as you've done the hard work up front to build the plan correctly, you're going to be fine. You're going to get through it. And so for all the 5 or 10 or 15 reasons you can list off to me this year on why we should sell and go to cash and panic, run for the hills, buy a bunch of guns, butter, and gold in a bunker in your backyard, there's going to be 5 to 10 or 15 new reasons next year, and you're going to forget the reasons that you were worried this year. And in fact, I have this happen where clients say, Nick, I'm really worried about this. I'm really worried about that. And then the next year, I've written it down. I've taken a note. The next year, I'll ask them, hey, do you remember what you were worried about last year? They're like, no. And I tell them, and they start laughing. They're like, oh, that's ridiculous. I can't believe I was worried about that. One of them was some client was worried that we were going to get nuked by North Korea. And they're like, Nick, what am I going to do with my portfolio when we get nuked? And I'm like, your portfolio is going to be the least of your concerns if we get nuked. Okay. So be careful with these irrational fears. And I did bring that up to the client kind of jokingly, and they had completely forgotten they even had talked about this that we had talked about this together. So it's just funny to watch that happen over time. Don't panic. Don't do anything crazy or ridiculous here. Just stay on your plan. If you don't have a plan, you need one, and we'll get through the next couple months. We'll be just fine. So probably a correction coming. I keep saying it. We'll enjoy the market all-time high while we can. Probably a correction, maybe a little bit of a downside here right before the election. But after the election, we're going to get some certainty in the markets. And I do think we're going to at least have gridlock. That's a good thing for markets. So stay on your plan. We are going to new all-time highs. It's just a matter of when. And I think you're going to be very happy you stayed on your financial plan here. So thanks for being with us. This was episode 162. We're going to be back next week with you for episode 163. Thanks for being here. We'll see you next time.